So exchange rates are either held constant or allowed to fluctuate, but in a very narrow band, narrow boundaries or band. So central banks can reset a fixed exchange rate by devaluing or reducing the value of currency against other currencies. So in that case, government is directly influencing or directly participating in forex market. Similarly, if the value is going down too much, the central bank can increase the value against other currencies as well, right? Now, what is depreciation or appreciation? So depreciation or appreciation represents the decrease in the value of currency that is allowed to change in response to market condition. So thus the term depreciation is more commonly used when describing the decrease in value. The term appreciation is more commonly used when describing the increase in value, so that are not subject to fixed exchange rate system. So many of the students, they are telling me, when we read the text, it is valued upward or valued downward. Why we can't use the term depreciation or appreciation, right? So in fixed exchange rate system, the government use the terminology like this: devalue or revalue upward, right? So when we talk about depreciation and appreciation, the mechanism or the definition is the same, but these are used for other currency systems. So examples of fixed exchange rate systems. So we are in the era of 1944 to 1971, when the world signed agreement on Bretton Woods Agreement, in which they say that every currency would be valued in terms of gold. $1 worth of, for example, 0.01 or just 1 gram of gold. It means how much is the dollar a country has, he can issue accordingly. That's it. If issue more currency, and he has to back up with the gold, he needs to buy more gold, right? So you can claim gold as well. You can go to the central bank and say, look, this is $30,000. I want 30,000 worth of gold. The company can give you. But then they pass the order, okay, you cannot claim the gold. You can just trade. This is bill backed by gold, but you can just trade. But you cannot claim, because carrying gold is getting more riskier. And then because still when people buy goods and stuff, in that case the dollar rate with other currencies were not be very stable, because now other countries, they don't have that much gold reserve, but currency demands are quite high. So what happened, the band is going to be violated every time. Sometimes for 20 days trading is just stopped. Why? Because bands are quite narrowed. So they entered into a new era, new agreement, 1971 to 1973. They entered into a Smithsonian agreement, in which they say, okay, if you want to devalue, so devalue till 8%. Previously, it's like very narrow band, 2% or maybe 3%, but now they increase the value. So what was the advantages? The advantages was it insulate country from risk of currency appreciation. So now tell me, is that a risk whether our currency is going up? Of course. So look at our discussion, our first or I think second lecture discussion, in which we talk about country's current account. What if we are exporting countries, right? If our value is start increasing, recent example, China is basically exporting country. So what if yuan goes up too much? Then outside world, they stop buying from China. They will say that we cannot buy from you. Why? Because it's cost too much. Rather, we should buy from our own local production houses or some other countries, right? So in that case, country will say that we didn't do anything, but because of this fixed exchange, because of not fixed, because of this, because our currency shoots up, in that case we cannot sell. So in that case, country is quite satisfied. So they eliminated the risk of currency appreciation because everything was fixed. Allow firms to increase and to engage in direct foreign investment without currency risk. When you know that we are eliminating the currency exchange risk, it is fixed. So we are investing now, and after some time we'll be receiving this much money. So your planning was quite good. So you go directly to other countries, invest directly, in their property, in their institutions, or buy stocks of stock market or other currencies in that country. So you eliminated the risk. What is the biggest disadvantage? The disadvantage is that the government will alter value of the currency, because in fixed exchange rate system, government directly participate. What if a new government come, or next day the central bank announce, okay, we are going to revalue upward, then maybe you are betting, or you are very good, your analysis was very good regarding depreciation of the currency, because that's what's going on right now. But the government next day changes the scenario and you are in heavy losses. The last one, which is quite disturbing, that is country and MNC may be vulnerable to economic condition in other countries. So in their analysis, the value should go down. In their analysis, the value should go down, but the central bank is fixing the currency and everything is going to be disturbed, and the economy is going bad because you already signed the fixed exchange rate system, right? So that was the pros and cons of fixed exchange rate system. Examples are, so assume that there is only two countries in the world, United States and United Kingdom. Assume a fixed exchange rate system in the two countries. So if United States experience a high inflation, right? Then United Kingdom, the US consumer should buy more goods from UK, right? And British consumers reduce their imports from US. So this reaction will force US production go down and unemployment go up. So what's going on here? So if we are understanding the drawback of fixed exchange rate system, so for simplicity we assume that there is only two countries. If one country experiences high inflation means people have more money, prices are rising. So people have more money, prices are rising. So imported goods looks very cheap. So people are buying more from foreign countries. So look at now at foreign countries perspective, UK. So what's happening in UK? If everything is bought by American consumer, then in United States, inflation start rising as well, because businesses are getting more money, people are getting more salaries in UK, and in UK they didn't experience high inflation, they didn't experience high interest rate whatsoever, but their inflation start rising. So in 1960s, that's why people are arguing that we need to change this. Why? Because in that case you are exporting inflation to other countries. So in this case, US is exporting inflation to United Kingdom, right? So United Kingdom blame US that you are exporting inflation in our country. Why? Because you cannot control your inflation and your people are buying my products, and in our country we have a shortages of product because your product is more expensive. And what happened? We are experiencing inflation, right? So in mid and late 1960s, United States experienced relatively high inflation and was accused of exporting inflation from other exporting countries, European countries as well. So for simplicity, we assume two. But now if we see the late 1960s scenario, So when we have fixed exchange rate system, so United States inflation was exported to European countries more. So that's why they ended up the fixed exchange rate system. They revised it. And now free floating exchange rate system. So in which there is close to zero involvement by the government. So it means free forces of market supply and demand, they determines the exchange rate. So exchange rates are determined by market forces without government intervention. A free floating exchange rate adjusts on a continual basis in response to demand and supply. So what are the advantages of free floating exchange rate system? Country is more insulated from inflation of other countries. So in that case, that problem that, okay, UK is exporting inflation to us is now gone, right? Because if US inflation rises, its currency go down, right?
Uh, so how do they do in order to isolate themselves?
So if US is experiencing high inflation, its currency will go down. Previously, in fixed exchange rate system was fixed, cannot depreciate or cannot devalue, right? In free floating exchange rate system, so recall our discussion. If inflation is high in a country, what happened? Its currency starting depreciating. So in that
So
case,
so just in order to understand, on the international market, you can decide to keep a fixed exchange rate regardless of inflation or not.
yes, that is the fixed exchange rate system we talked about, fixed exchange rate system. And now
Okay.
we are talking about free floating exchange rate system, in which government cannot intervene or cannot participate to control exchange rate. So the advantages are, the one country who is experiencing high inflation, it cannot export its inflation to other countries, insulated against inflation from other countries. Country is also insulated from unemployment of other countries. If in one country there is unemployment, it doesn't mean that other countries also experience the unemployment. That was the characteristics of fixed exchange rate system. So they are also insulated against that one. Plus, government role is also not required. So central bank is not required by the government. So let the market decide. What is the drawback here? Do we have yeah, we do have drawback. We'll talk about here. But let's just talk about the example here, free float exchange rate system. So if we continue our previous example in which only two countries in the world and US experiencing high inflation, right? So when US experience high inflation, it will demand more foreign products because foreign products, British product looks more cheaper. It will buy more British goods. So demand for British goods go upward. So what happened? It will also, because people will be buying more US goods, so they will be converting their US dollars and buying pounds. So pound demand is also going up. In that case, pound start appreciating. The second consequence is that the high US inflation reduce the demand for US, will result in a reduced supply of pound for sales. And what happened? Upward pressure on British pound. The pound will appreciate due to these market forces. In that case, now it will look more expensive, for US consumer to buy from US. They will buy their local products. So in that case, inflation is not transferred from US to from US to UK. So this appreciation will make British goods more expensive, even though British producers did not raise their prices. Higher prices will simply due to the pound's appreciation. So this is a greater number of US dollars are required to buy the same product before due to appreciation of the pound. So in that case, one country's problem of inflation and unemployment remains in